Hello everyone and welcome to this month's special webinar with myself, Craig Erlam, Senior Market Analyst at OANDA. This month I'm joined by my colleague in New York who is a Senior Market Analyst over in the US, Ed Moya. Ed, do you want to say hello? Ed?
Yes, good morning, Craig. Can you hear me?
Yes, perfect. I think you were on mute there. That's a hell of a start. We've just we've just managed. Hopefully, that is as far as the technical difficulties will go. Yeah, so this is one of our series of monthly webinars. This is where we preview the month ahead. Slightly extended webinars for live account holders only. We encourage you to ask as many questions as you wish. Hopefully, we'll be able to assist with any questions you have with relation to the markets, and if not, we will continue to talk. Thankfully, we do live in quite dramatic times, so there is plenty to talk about, and I think an hour is probably going to fly by if the last webinar is anything to go by. Hopefully you can see a screen right now. The screen right in front of you is MarketPulse. That is where you will find all the content which we post on a daily basis, the analysis from myself and Ed, but also our colleagues in Toronto, Dean and Alfonso. You can see Kenny there as well as our colleagues over in Singapore too. So there's plenty of content here. It's also where you'll see the economic calendar right here. And that's effectively what we use to give us a heads up of for the upcoming events, be it daily, weekly, or in this case, which I've got in front of us right now, monthly. But without further ado, we'll crack on. We'll try and cover as much as we can, and we'll obviously take a look at some charts as well in order to assist us, and we can therefore relate it back. I think the best place to start, Ed, and I'm sure you agree, is over on your side of the pond. I think it's safe to say the US is at the center of almost everything market related right now, bar one special topic close to my heart. So let's kick things off over there. I guess the best place to start is probably the Fed. Would you agree?
Very much so. I think Friday was a momentous day. We saw the Fed Chair Powell kind of correct his earlier mistake, if you want to call it, from the December meeting, where basically kind of signaling to the markets that these rate hikes they're going to be on hold, and also signaling that the quantitative tightening is no longer on autopilot. Friday was a really busy day. We had the non-farm payroll, which number was above the highest estimates from the economists that cover this figure, and we also saw wage data. It's really interesting when you take a look at the U.S. economy. We have robust employment numbers, wages are kicking, and when we take a look at the Fed regional surveys, when we take a look at these sentiment indicators, there's weakness. So you have strong jobs, but there's global concerns on everything. And then you have the Fed, who everyone knows is data dependent. Everyone knows that the Fed is trying to get their interest rates closer to neutral, and we've been seeing the U.S. dollar really strengthen for much of 2018 on this stronger U.S. data, on this Fed tightening cycle. And what we saw was Powell, he basically kind of took back some of that over optimism as far as their rate tightening schedule. They addressed the dot plots, which when we take a look, they were pricing in 3 at the end of the September meeting. They brought that down to 2, and everyone was still thinking that is way too aggressive. The market, for the most part, is expecting no hikes for or one hike at the very least for 2019. And if we take a look at the overall expectations for the U.S. dollar, it's going to really depend on how much do we see the Fed tightening going forward. When do they decide to pause their quantitative tightening? And these are a lot of questions that the Fed has still not really provided much clarity on the tightening of the balance sheet. When we talk about the balance sheet, everyone knows that the importance of it is that currently 50 billion a month is being taken off, and we really don't have an estimate as far as where that could stop. Some analysts are expecting it around 3.5 trillion. We're just around 3.8, so we could see them eventually pausing that closer towards the end of this year, and that all these major policy shifts that we're seeing from Powell is kind of something that some are attributing to him being a rookie. He made a very big blunder back in October when he said that the Fed may go past neutral. Then he waited about a month.
Said as well at the same time that they were nowhere near to neutral, which again was one of these kind of naive comments, which maybe as a Fed board member you can get away with, but as Fed chair you can't, right?
Exactly, and these little blunders, everyone, you have to remember it's his first year. He started in February, and he had to correct it. And then it's like December. Some people are saying he did make some policy blunders there, and Friday though he basically set the market straight. The markets liked it because we saw equities rally. We saw, in addition to the stock market rally, we did see high beta currencies also take off as well.
How much of Friday's comments do you actually think were a slight shift in policy stance, though? Because I looked at his comments in October. He then made a speech. It was either late November or early December, where he effectively appeared to seek to clarify those comments. He slightly adapted his language, saying that they're effectively close to neutral, not that far away. And then at the meeting itself, they seem to seek to clarify things a little further while showing that they are adaptable. The comments that we had at the end of last week seemed to be a significant shift away from that, because he really wanted to stress their flexibility, the fact that they are focusing and paying attention to financial markets, that they are not ignoring what is happening in the wider world. This felt to me like more of a shift, and not necessarily a Trump-driven shift, because I know because Trump's been so vocal in his criticism of the Federal Reserve and of Jerome Powell in particular, they're naturally going to draw a link between the two. But I think we can't ignore the fact that we are.
Craig, I think you cut off there.
Deteriorate over the course of the last 12 months. We've seen some of the surveys are starting to show up as well. We're seeing global measures as well, suggesting that we are in the midst of a slight slowdown, particularly in China. The trade war hasn't abated, although we are seeing negotiations now. And even companies. So last week also we heard from Apple, who suggested that the slowdown in China is having an impact on handset sales, suggesting that the trade war is having an impact. Today, we've heard from Samsung. It seems like there's multiple factors which have contributed to this slight changing tone from my perspective, and that it's actually led to a potential shift within the Fed to move away from what they were previously alluding to, which is 3 rate hikes in 2019, down to 2, maybe even to 1. And again, this is one of the reasons, I guess, why I was critical of them raising in December. I didn't think it was a necessary 4th rate hike of the year and offered them more flexibility this year. So how much of it do you, I guess, ultimately I'm asking is, how much of this do you think is an actual shift of policy stance from Powell, and how much of it do you think is bending to market will and maybe even Trump will?
I do think, let's address the latter part first. I do think the Fed is very clear in being independent from the president. I actually believe that if we did not have a president that was so vocal in December, that there could have been a greater consideration for pausing.
Yeah.
it's something that the Fed had to reassert its independence, and the data did support it. However, the global risks definitely did not, and we are still seeing robust data. The economy is strong. However, we're not likely to see inflation to remain at these levels, and then also the global risks are growing, and I'm glad you mentioned Apple. That's a pretty interesting story, because when you take a look at the Apple warning, and it was pretty amazing how that did come out when it did, and the reaction we saw. However, when we take a look at that warning, the timing was really poor. Apple, there was not much new that came out in the last few weeks. This was something that Apple probably should have telegraphed a lot earlier. Mm-hmm. I think we are seeing weakness definitely with any major exporter or major trading partner with China, and this is something that we're going to probably see a lot of going to earnings season. A lot of countries that are exposed to those risks have to cut their guidance, and that's something that the regional surveys, the confidence, the sentiment indicators have really pointed towards that. So I do think that the Fed was playing a little bit of catch up there. I also think that when it comes to the trade war, that's an area that everyone really, I think, believes that we're starting to see this really hurt the U.S. economy too. So not just China. I think earlier and this trade war has been going on for a year now, that the almost a full year now, and we're starting to see both sides are going to be motivated to move forward with this. And I think that once we do see further progress, once we might see, you and I, we probably hate this saying, but kicking the can down the road, they might extend, let's say, we'll hold off on raising, the tariffs. Maybe they'll try to find some more concessions, some positive spin on pushing this out. But, the end all expectation, though, is for this trade war to eventually be resolved, and probably not by the March 1st deadline, but we'll probably see some concessions from possibly both sides. And I think the Fed is trying to look beyond that. And once we are beyond that, the justification for 2 hikes in 2019 could be the case, but in the short term, it is not. So I think that when we're into the fall of this year, we might be considering that second rate hike. There's many variables that are coming into play for this forecast, and ultimately we will probably see this changing in expectations really provide a volatile movement for the U.S. dollar.
Yeah, I think you're very right, to be honest. It is interesting, this whole 90-day extension for these trade negotiations, because the world's 2 largest economies bridging a gap that was huge in 90 days. Comprehensively, which is what Trump assured us it would be, is so unfeasible. But I guess, as you said, all we need to see is some sign that progress is being made, a sign that we're not going to see more tariffs imposed, that we are working towards tariffs being removed. And I think that would be a major headwind for the market that would start to ease somewhat, and would prevent, would take some of the weight and some of the drag off the markets that we have seen. And I think that's a major concern for markets right now, because it has escalated so much so quickly. And I think the next round of tariffs would probably have been the most painful. You alluded to the fact that, yes, there has been some economic impact of the tariffs on the US. There's probably been a greater impact so far on China, and I think the greater impact would still have been to come. But the next batch of tariffs could have caused a lot more pain for both sides. The third batch of tariffs for the US, for example, contained a lot more consumer goods. So from an inflation standpoint, from a consumer spending standpoint, that would have been far more painful for the Trump administration to stomach if they were forced to follow through on this. And therefore, I think there will be a desire on both sides to work towards this agreement. But we just need to see signs that these talks are progressing as planned. They are obviously taking place at a more junior level at the start of this week in Beijing. Maybe we'll hear something on the back of this. Trump suggested that they are moving well, but I mean, there's only so much you can read into Twitter commentary at a time when the markets are falling, right? I think that's probably a good point to move on to the charts, to be honest, and let's have a look at some US dollar pairs, because as you've said, the dollar has been weak on the back of these expectations. One more thing to highlight here is this is the December probability from the CME group. And at the moment, there's a 72% chance the market's factoring in of no rate hike this year. No rate cut either, but there's also 11% chance of a rate cut here. So roughly equal on both sides for a rate hike and a rate cut. That is not a market that suggests what the Fed is telling us is completely in line with the truth. So I think that's really interesting. And even at times last week, you saw that the probability of a rate hike next year was 0%. It was quite staggering that when the Fed was saying 2 rate hikes this year, that the market had a 0% chance factored in. And there was actually more of a chance factored in of 3 rate cuts than a single rate hike. Again, that was quite staggering from my perspective. But in terms of the charts, I mean, we look at things like the euro dollar, and we've seen some weakness in the dollar, but it's not really taken off yet. And I don't know about you, Ed. I find it a little surprising that we've not seen more weakness in the US dollar, because yes, it is one of the few central banks that's been raising interest rates, and yes, the economy is performing at a level most countries would be envious of. But we are coming from a period of significant dollar strength. There's been a significant shift in Fed policy. There's been a significant shift in market expectations for US interest rate hikes. We've seen an inversion of the yield curve, and we've seen a global growth slowdown. We've also seen an improvement in tensions between the US and China, and when things were escalating, that was beneficial for the dollar. It's not really declined that much. What do you think?
I think when we take a look at euro dollar, you could see that we've been really range bound. We've been stuck between that 112, 118 area, or more recently, 115 has been the ceiling. We can't get any key driver. And when we take a look at the eurozone, I think we also have to take a look at how is the trade conflict also affecting Europe, and we are seeing these terrible prints from Germany. And just this morning, we were looking at industrial production and horrible misses. And when you take a look at that, it's basically implying that we're going to possibly have another poor reading for Germany, for GDP, which would signal a technical recession. So hard to imagine the ECB hiking while Germany is in a recession. So we're starting to see that this after summer calls to raise interest rates for the ECB, unlikely. Lots of uncertainties on who's going to head the central bank for the ECB. So are we going to have a dove, a hawk? Most likely, it's not going to be a German. And if that's the case, it's really hard to provide a good short-term catalyst here for the euro to continue to rise here. It has stabilized, and but we are seeing that 115 level provide major resistance right now in the short term.
Yeah, so you think that Mario Draghi is going to see out his term as the only European Central Bank governor not to raise interest rates in his 8-year term then, because those of you who remember back to 2011 will remember that he took over at a time when the central bank had only just cut interest rates, his predecessor Jean-Claude Trichet, and straight after there was a very much a major U-turn that took place. And since then, there's been zero opportunity for him to raise interest rates. I almost can't help but feel Draghi will be desperate to raise interest rates at his last meeting, to almost draw a line under the Eurozone crisis and say, we guided Europe successfully through this crisis, and almost as a symbolic gesture, we've raised interest rates at my very last meeting. It's now on to the next person to take us onwards and upwards.
Well, it's when you take a look at money markets, they're not pricing in that 10 basis point increase until the middle of 2020. So yeah, it would be wonderful for him, and it'd be a nice end to his tenure. But as of right now, the market's not pricing it. The data has been, pretty weak for Europe. So if I were a betting man, I would be very cautious on calls for him to deliver that hike.
Yeah, markets and central banks really aren't on the same page at this moment in time. The ECB only in December reaffirmed its view that it'd be back end of the summer really when we'd be looking at an interest rate hike there, but markets very much not on side. Same can be said for the Fed, and we'll touch on shortly. Bank of Canada is another one where we seem to be a confusing situation arising. UK, it's very unique in our current situation. But yes, ECB and the markets seem to be very much on a different page. Who do you find yourself falling more in line with? Because markets, they can over-exaggerate, and they can be a bit go a little bit far, you can say. But central banks, they do tend to make changes. They do tend to come a little late in the day round to the market's way of thinking. Just thinking back to a decade ago, the market seemed to be very much ahead of the curve here before central banks almost acknowledged it. Are we seeing a situation where central banks are just dragging their feet and falling in line with market expectations, or have market expectations gone too far at a time of year when markets are very illiquid and are prone to over-exaggerations?
A little bit of both, and I think that, as we've seen, forward guidance has been probably something that's making these central bankers look like flip-floppers, because the data has been good, it's been bad, and there's the expectation that I think that the whole trade war thing really kind of messed up everyone's forecast, and the uncertainty on when it's going to be resolved is something that it's a variable that is important, and it's going to affect all the major data points. And until we have that clarity, there's an inability for these central bankers to provide really, sound and effective forward-looking targets.
Okay, we've got a question here from Stephen Cunningham, and it's a bit of a long one, so I will read it all out and then get your thoughts, Ed. It's all right, Steve, don't worry. So he asks, is this because the global slowdown has not impacted the US as much or fast as the rest of the world, and that along with Brexit and trade uncertainty, I'm surprised that even negative US data doesn't seem to have that much negative impact in those pairs. Is the US still being considered a safe haven in spite of equities selling off recently and negative data? It seems confusing. I'm hearing so many mixed ideas on what caused the equity sell-off to no worries on US equities, etc. He's effectively and asking, are we bullish US dollar at the moment or bearish neutral? I guess what he's asking here is what exactly is causing all of this, because you read different media sources and they're all pointing the finger at different things. What is your view on what is the main cause of the market instability and turbulence right now? And are you personally bullish or bearish the US dollar overall, I guess, the US dollar index?
Well, to first take a look at my overall opinion on the US dollar is that we are starting to see that Friday we're going to be talking about Powell's shift on that he provided for us on Friday for quite some time. It really is changing expectations as far as Fed policy going forward, and I do believe that he sent a clear signal that the U.S. dollar, as much as it appreciated in 2018, this is going to be an area where in the first half of the year we could see some dollar weakness, we might see it shine versus, let's say, the commodity currencies and emerging market FX. It might be really tough to call as far as I think we might be more range bound on euro dollar, and pound dollar is going to be at the mercy of Brexit, which I'll let you lead that discussion in a little bit. But for the U.S. economy, the economy is still, certain components of the economy are strong, and as we start to see that more dovish spin on expectations for that tightening cycle, as far as quantitative tightening pausing, you're going to see that continue to be supportive. You're just as we saw the China's central bank, the PBOC, delivered that triple R cut. We're going to probably see more accommodative behavior from these major economies, from their central banks, and that is going to be, for the most part, very supportive for the high beta currencies. It's going to be something where we could see Aussie, the Kiwi, the Canadian dollar, and the euro benefit on the first half of the year, if we see that progress in trade talks, if we continue to see an improvement on the data globally. So it's a long answer, but the I think expectations right now is that, you know, we're not going to see that tightening cycle immediately deliver a rate hike until possibly the summer. It might be June, might be when we really start to consider that Fed next 25 basis point increase. So until then, there's a lot to happen, and we could see that be an area that we'll focus on. And the other key thing right now is the stock market. The stock market is also providing some of these key moves in FX, as you know, we're kind of range bound, and if we do see one last push lower in U.S. equities, you know, that could be the providing us with a key bottom for these high beta currencies against the U.S. dollar. So the dollar could be poised to possibly have some more strength in the very, very short term, but ultimately taking a look at the fundamental drivers, you know, we could see it poised for some weakness.
Yeah, I think I agree with everything you said there, and I think with regards to the dollar, I think one of the things, the only thing that worries me about the dollar, because for those of you who listen to these webinars, I've been bearish the dollar for a little bit now, for a couple of reasons, really. One, I just thought Fed tightening was priced in. It seemed that there was far more dovish downside than there was hawkish upside, if that makes sense, to be found, and that has materialized now over the last month or so in particular. It was also a factor of other currencies as well. The Italian situation looked to be moving smoothly forward, which I thought may be supportive for the euro, and maybe has been, but not to the extent that I was hoping or thinking. Sorry, Brexit is taking its time and dragging its feet, but assuming the outcome is that we'll enter into a transition period on the 29th, after the 29th of March, that should be bullish, I would think, for the pound. So you're looking at all of these different currencies and saying that this should be positive and this should be positive for this currency. Well, all that weighs up against the US dollar, which has been strong for so long. And even if we look at trade war, the escalation of the trade war was bullish for the US dollar, because the US was seen as being least vulnerable in an escalating trade war. That's not to say that they wouldn't be harmed, but that others would be harmed to a greater extent. So progress here, again, you would think would be US dollar negative as a result of that, the opposing effect. The risk for me is that we've seen a number of these start to materialize. We've got the US and China are in talks for over a 90-day period. That's progress. We've seen the Italian situation has been resolved. The budget's been signed off. That's progress. We've seen we've seen improvements, really, in my view, across the board, and the Fed's become more dovish, and yet the dollar hasn't weakened that much. That suggests to me that there's still a a significant resistance to dollar downside. Now that could break at any point. I think when we're looking at the dollar index as an example, which I don't have a chart on me right now, but I think it's around 95.5 seems to be that really solid support line. If that breaks, then maybe that resistance starts to be broken down. But at the moment, the resistance seems to be quite strong, and that can sometimes be a little bit of a worrying sign. We'll see how that materializes, especially once Brexit progresses and we start to see risk return. I think a really good barometer actually for the dollar and the US as well really is gold, because gold has an inverse relationship with the US dollar. The two of them do move strongly in unison. There's typically two things which can strongly impact gold. One is the dollar, because obviously with it being priced in dollars, so a strong dollar is typically associated with cheaper gold, and a weaker dollar is typically associated with a more expensive gold. And the other is risk. So recently we've seen risk off markets and we've seen a weaker dollar, and I think that's why we're seeing gold heading up towards this $1,300 level. We've run into some resistance there. I think this is broadly profit taking, but I think the return of risk appetite over the last since Friday has probably taken some of the shine off of this as well. But we are cutting back a little bit. I think we can break through that $1,300. I think dollar weakness can prevail for longer. There may be a bit of a correction in the near term through 1280, maybe even back towards kind of 1260s, but I still think this looks bullish. So that almost reaffirms my bearish view on the US dollar. Now, one thing that you could say is, well, if we do see return of risk appetite in the markets and we're starting to see signs of that now, should that not be bearish for gold? You could argue that, but if that return of risk appetite is accompanied by positive progress in trade negotiations and positive progress on Brexit, which I would associate with an improved risk appetite, well, that will ultimately be bearish for the dollar. And while I think weaker risk appetite and a weaker dollar is ultimately the ideal bullish scenario for gold, I think the dollar is the primary driver here. So as long as the dollar is softer, then I don't think risk appetite is going to create too much of a bearish environment for gold. I think this looks bullish, and if we can break through 1,300, then I think we start to see another leg higher. Do you have any views on that, Ed?
I do, and I agree with you as far as gold being a very strong in a strong bullish trend. And when you take a look at some of the pressures we've seen the metals go through in 2018. If we do see that improvement with commodity currencies, and it's all going to rely upon that trade talk, we could see that upside for gold, possibly retest the 2018 highs, which we're talking about 1360. So 1300 is very key resistance. So if we do clear that hurdle, there's not much resistance for quite some time.
Cool. Right. I think we've covered the US quite well, to be honest. Again, keep the questions coming if you have them. I think we have to talk about Brexit. I'm sorry to anyone who's bored of it. I can promise you, no one is more bored of it than I. But that's where we are right now. I think just to give an overview on where we stand, we now are in a situation where tomorrow MPs will meet in Parliament, and 5 days of debates will begin on the deal which May's got. I imagine it's going to very much sound like the 5 days of debates which happened last time prior to the vote being cancelled, given that nothing seems to have been agreed with the EU to appease some of the numerous people in Parliament who opposed Theresa May's deal. The parliamentary vote on the deal itself looks set to occur on the 15th or 16th of January, so either a week today or a week tomorrow.
I think they just announced it's going to be on the 15th, or they're proposing it for the 15th. Sorry.
15th, yeah. So then it's a case of whether it passes or fails. If it passes, then it's a case of just sorting out the paperwork, agreeing all the finer details. But then it effectively means that we are leaving the EU on the 29th of March, entering into a transition period. And if no future trade deal is negotiated within 21 months, then we enter into the backstop if no extension to the transition is agreed, which it probably would be, probably for 2 years, I think, at that point. And then we would enter into the backstop if no trade deal is agreed. between the UK and the EU. What's more likely to me at this moment in time is that it fails, and that opens up a whole variety of routes that this can then head down. I'll go through a few of the more likely options, but don't be surprised if numerous more open up along the way. It seems that with every passing week, we hear about a new route that this could head down. So this is going to be a changing moment for this situation, and we will have to adapt as we see as we go. For me, the most likely follow-up to a failure of Theresa May's vote, given that she's failed to get any new assurances from the EU which will satisfy MPs, would be a no-confidence vote in the government. I think this would be a situation whereby Jeremy Corbyn may believe that the DUP will withdraw its support for the government, despite being part of that the agreement, which effectively has formed a coalition government between the two, accepting £1 billion in the process. And Jeremy Corbyn will call for a vote of no confidence if that vote garners more than 50% of MPs in Parliament. Then the UK Conservative Party would have, I believe, 2 weeks to form a new government which has the confidence of the House of Commons. A failure to do that would likely then lead to a UK general election, probably an extension of Article 50 beyond the 29th of March in order to account for this. In that event, then that would probably take us to around mid to late May. And they could extend Article 50 even without that, which is a possibility as well. It would likely go towards the 23rd to the 26th of May, for the simple reason being that that's when we have European Parliament elections. Obviously, if the UK is still part of the EU at that point, then there will be UK candidates. I think that will want to be avoided. So I think they'll want to have Article 50 at the very latest extended back to the 23rd to 26th. That should allow for an election to take place if need be. The other option would be to revoke Article 50 altogether, which the European Court of Justice recently stated that the UK is within its right to do. Another option, which I think is less likely still in the current format, would be a second referendum. If Jeremy Corbyn and the Labour Party fail to gather enough support for a vote of no confidence, then I think they will shift their calls to a second referendum, so that a people's vote on Theresa May's deal versus Remain versus no deal. Again, I think this is extremely contentious, but if there is enough opposition within Parliament, then they've passed the buck before. Why wouldn't they do that again? But I think that would be one of a kind of last resort solution in order to avoid no deal Brexit, which there is absolutely close to zero appetite for in Parliament, even if some of the more hardline Brexiteers would more than happily take that approach. I just don't think there is the numbers for it. Of course, if the vote fails, then Theresa May has 21 days to report back on plans for what to do next, which could again open up a whole new line of where we could be headed. So that's the general the general way in which we're heading. One option for Parliament, obviously, is to put forward a plan B, where they suggest alternative trade arrangements, which could get the numbers in Parliament and supersede Theresa May's deal. This is again in the event of her vote failing in Parliament and Theresa May not being able to convince parliamentarians to vote one way or another. One of the options which is being touted is called Norway Plus. I love the fact that we always add pluses to all these trade agreements as if we're because we're obviously a special case and therefore we deserve special terms. But the Norway Plus effectively keeps the UK in the single market and customs union, continues with free movement of people with the ability to put a stop on under special circumstances, and countries with the Norway-style arrangement in the EFTA, in the EEA, can effectively withdraw from that agreement with a year's notice. There are a number of reasons why I struggle to see this even passing. One of which from the UK side is I don't think the UK Parliament MPs and those who campaign for Brexit can really stomach the idea of being within a customs union and single and free movement of people. From the EU side, the ability of the UK to unilaterally withdraw from this agreement with a year's notice is the reason. There's a reason why they haven't included that in the backstop. It's because they claim that they don't want a border on the island of Ireland. So why would they agree to something which gives that out when it's something they've rejected before? So again, another option that I don't see as being feasible. For me, I think the next phase is that we see a failure of the vote in Parliament, and then we head into the no confidence vote. I think it's going to go right up to the deadline. I think we will probably, it's strongly likely to see an extension of Article 50, and after that, I think it's fair game. What's the view? Sorry for all the rambling. I just wanted to provide a clear outline for what we're expecting. What's your view over there, Ed? Are you guys following it closely, or is this something that, given your own domestic issues, kind of just falls off the radar?
It is being followed. When you take a look at the U.S. media, though, over the past couple of days, it has been quiet. I think it was nice. The Parliament recess was respected, and we did kind of have a little bit of a break from Brexit. I think it's much discussion with little progress. But when we take a look at price action, when we take a look at the British pound, we are 8% higher from that key low, and I think the general consensus is that. And as you know, it's nice that we actually have some set deadlines on when some of these decisions need to take place, or votes have to take place, that eventually that a soft Brexit is still kind of where everyone is expecting it. But negotiations will have to get worse. We'll have to see May lose this first vote, and the risk to cable, everyone is eyeing that 120 level. Expectations are for the risks for the hard Brexit to start to gain momentum again. These unlikely scenarios to gain some steam, and then eventually for everyone want to settle on that soft Brexit, because some of these other outcomes would be extremely detrimental to UK business, and as far as money going into placing these longer term bets, the volatility though is the risks are still too wide that many are still on the sidelines. So everyone is eyeing some of these key levels, but for the most part, if we do get that soft Brexit, the expectations are that we could see 135, even possibly 140 once everything is resolved. But we're far from there. So it's more of a wait and see until we see greater progress. But for the short term, we're gonna see again this volatility. December for the most part was a fairly tight range for cable.
Yeah, I think as you alluded to earlier, we're kind of in Wild West territory when it comes to sterling pairs right now. The swings to the upside and the downside could be quite severe, and I think that's something that anyone who's trading the pound needs to be fully aware of and be prepared for, because the news that comes out isn't always expected. It's not always a vote in Parliament. It's not always an agreement with the EU that's from a scheduled meeting. A lot of the things that are causing these dramatic swings in sterling are rumours. It's speculation. It's unforeseen announcements. These type of things are having dramatic impacts on the pound, and it's worth considering. And as Ed just alluded to, the potential upside in the event of a soft Brexit agreement, be that Theresa May's deal eventually getting over the line, be it Norway plus, or anything else. The potential upside is quite great because, in my view anyway, and the reason is, as Ed's alluded to again, it's pro-business. And it protects the economy. It provides a buffer to the economy. And while it may be politically difficult for many people to stomach, particularly those who supported and voted for Brexit, are concerned with the hostile domestic environment that could ultimately ensue from such an agreement. The markets are concerned with business-friendly policies. They're concerned with an economy that thrives, and what is seen as the greatest risk to the economy is it is certainly a harder Brexit, or a no-deal Brexit, ultimately the worst-case scenario, and that could provide some significant downside if it looks like that's where we're heading. For me, I don't think we're heading towards that scenario, but again, we've got to look at risks, and the risk for me is that these things tend to go up to the 11th hour. These things tend to be resolved a minute to midnight, and I feel like we're heading for a similar scenario right now, and the closer we get to midnight, the more volatility we see and the more potential downside we could see for the pound. And it's not just against the US dollar. We could be looking again about the pound yen, for example. You've got a high risk Brexit currency versus your safe haven currencies. Obviously, with the yen, you have to factor in the fact that we have seen a recent low because of that kind of. It's not exactly a flash crash when it's rising in the yen, but the yen did rally extremely strongly on the back shortly after those Apple reports, when the markets went into severe risk aversion mode, when we saw a significant downside in equity markets, and the impact was widespread. It's not often that you see an equity story flow through into currencies, but when you see such significant risk aversion at a time of such illiquidity, and this wasn't just festive season liquidity. This was festive season liquidity at a time of day that falls in this kind of witching hour between the US and Asia sessions, when liquidity is already low, and also at a time when Japan was celebrating a bank holiday. So there was an incredibly illiquid moment in the markets when we saw this flash move. And again, it's not just an OANDA flash move. This is across the board. You can check a Reuters platform, you can check a Bloomberg platform, anything. These yen moves were severe. But what happens when we see these kind of moves is I tend to almost ignore the spike in the near term. So when we're looking at near term support, I'm looking at these kind of levels again. The levels where we kind of stabilized around after the actual flash move itself, around the kind of 135, 50, 136s. We've moved higher off of these levels, but you can see the kind of dramatic moves we've even seen in this pair over the last couple of months when things have taken a turn for the worse. Again, you've got the high-risk currency, Brexit-related currency in the pound, and you've got the ultimate safe haven currency in the yen. So it's worth bearing that in mind here. Maybe the sterling CAD as well is another one that could be potentially interesting here. We've seen a lot of volatility in this move, but again, I guess probably this is a good point when we bring in the Canadian Central Bank, actually, Ed. What do you think? Because it's become really clear in the last in recent weeks that people are increasingly unsure which way the central bank is heading, and not only are we maybe not factoring in rate hikes now, we're factoring in potential rate cuts, which again may be a sign of where we are with the markets. What's your thoughts on this, Ed?
Canada it's amazing when you follow the interest rate probabilities. When we were before the holiday season kicked off, it was pretty baked in that this January 9th meeting was going to be a 25 basis point increase, and then slowly that just went away, and now the expectations for the January 9th meeting, we're at yesterday was at 20%. Now we're at the 18% probability that there's chances for a rate cut. Now, what many are focusing on right now is that why is everything really becoming so volatile with the Bank of Canada expectations? And when we take a look at oil prices, that's one big component of it. When we take a look at the data, though, let's just forget about oil for now. The Canadian data has been fairly strong. The expectations, have been jumping around, mainly because everyone takes a look at what is the Fed going to do, and a lot of times we'll see a lot of these central banks just try to follow pace, but for Canada, the shifting has been a little bit too dramatic, if you ask me, and we're starting to see there's a small group of analysts that are even expecting that tomorrow the January 9th meeting could be a possible surprise rate hike. So there's a lot of uncertainty as far as what is going to happen with Canada. But when you take a look at the data, when you take a look at what crude has done and how crude has stabilized, and when we look at the overall expectations for the loonie, we have seen a significant amount of loonie strength, almost like 3% over the past few trading days. The expectations are going to be extremely growing for a rebound here, because the loonie has been pummeled. It was one of the worst performing currencies against the U.S. dollar in 2018, and you're starting to see the price react to that. Taking a look at the WTI chart, you can see that Christmas Eve low that we made, testing just around that 42.30 area, that was on thin liquidity. That was the market had an extremely light volume there, and that low, you could see, has been respected, and oil has been pretty much on a tear. It is finding resistance from that 50 level, but right now expectations, we've heard all the right things from the OPEC plus people, Saudi delivering on their cuts, constant headlines as far as doing everything to signal that the market is to expect that OPEC is going to possibly extend these cuts to when that does expire, and the significant weakness in oil, the 40% decline that we saw, did disrupt the shale business. It did disrupt U.S. shale companies, and did make them cut back on some of their capex. So while their shale is here, shale is going to survive. Eventually, we will see the U.S. dominate production here. But in the short run, we are going to most likely see this be a positive area for oil prices. So when we take a look at the expectations for going back to Bank of Canada, I believe that the most likelihood scenario is for no change in policy, but as we continue to see oil remain fairly stable, and if we continue to see the data remain fairly strong in Canada, we could see these expectations for the future meetings shift back towards the hike. So right now there's that. I think the market's kind of overreacted and went to cut mode here, but we could see following tomorrow's meeting a little bit more optimism here. And if that's the case, then you could see the loonie be poised for some further gains.
Yeah, I mean, you've probably seen me playing around with the screen here. I was just looking for this chart because, to go back to your point about what OPEC Plus is doing, one of the more interesting tactics that the Saudis have adopted, which I remember them doing the same thing a couple of years ago as well, is they were saying, we are cutting oil production. Our numbers may be slow, but we are cutting oil production, and the market isn't respecting that. So one of the tactics which they adopted, and there was reports about a month ago that they were adopting these again, is cutting exports to the US, because they know that people pay very close attention to the US inventory numbers. So it's only when these numbers start to take a hit that the market starts to respect the cuts which are taking place. And that's what we've actually seen is with the Saudis apparently cutting exports to the US, it means that US inventories aren't growing as they were throughout mid-September through till late November. And over the last month, we've actually seen US inventories actually declining, the numbers reported by EIA. And that looks set to continue, and we're expecting another flattish number again this week, because it's almost kind of like market manipulation. But the reality of it is it's Saudi Arabia saying to the rest of the world, you may not be paying close enough attention, and you may be paying attention to the wrong numbers, but we can show here as well that the market is having an impact, and we need and we want higher prices, and we are determined to make that happen. Now, the impact so far hasn't been overly significant, but we have seen a bounce in oil prices, and yes, as Ed said, the drop in WTI may have been partially driven by, or largely driven by, market liquidity. But the bounce back we've seen, I think, is markets paying attention to the fact that the inventory data is showing that the cuts which we're seeing and that have been announced are significant. They've been successful before, and it's providing that floor for the market that OPEC and its allies are seeking. So I think that's really quite interesting as well. In terms of going back to the charts, then I think we have had a question in relation to dollar yen. So let me just bring up that chart. And I know Ed has one or two charts which he wants to touch on as well. So I will pass over to him to wrap things up. Dollar yen, we've been asked, in the instance of dollar yen, news is negative for the USA. How does that affect the movement on the charts? That's from Richard. To be honest, Richard, it always depends on what the news is. There's news which has a greater impact than others. If it's a bad non-farm payrolls report, for example, then that could be typically negative for the US dollar. In terms of the US dollar yen, this is one of the charts where you could potentially see a greater impact. Again, we're talking about the yen flash move here, so you can't really pay enormous attention to that in particular. But because you've got the currency which would stand to lose from a negative jobs report, as an example, versus a risk-related currency, you can typically see quite significant moves here. So, for example, to the upside here on Friday when the jobs report came out, that was a dollar bullish report, and it was also a risk report as well. So risk appetite improved dramatically a lot with that, alongside the Powell comments. So that was negative for the yen because it was positive for risk. So that's the typical correlations, but these correlations aren't always set in stone. So it's worth taking that into consideration. We've also had another question. If we get some positive developments from trade talks, what are the expectations for Aussie dollar, US dollar? And what pair is recommended to be the main focus on trade? I mean, to be honest, the main pair for trade is dollar yuan, that's US dollar, Chinese yuan, because that's where the trade talks are taking place between. That's the countries that stand out as stand the most to win or lose. And as we've said already earlier, trade war escalation was positive for the US dollar at the time. So you'd expect the inverse to be true during these, if we do see an improvement in relations here. Obviously, Australia is intrinsically linked to China through trade of raw materials. So at times when China's doing well, that's typically a boost for the Australian economy as well, and therefore the Australian dollar also. So that, and as Ed's alluded to earlier, again, the high beta currencies will typically perform better during periods of stronger risk appetite, and an improvement in relations would typically be one of those occasions. Ed, shall I pass over to you, because I know you want to talk about dollar Swissy, following up on the previous webinar we did.
Yes, and let me go ahead and pass it, and I will take a look at that. All right, now right now I'm on Aussie yen, because I did want to just piggyback on that last comment. Aussie yen right now, you could see, and then as Craig was mentioning, the flash crash lows, you could see that was an extraordinary move. But the story that you're going to see with Aussie yen, just first I want to touch on, is that if we do see a very positive outcome with the trade talks, you could possibly see Aussie yen be one of the better outperformers, because you'll see a positive move for risk appetite. You'll start to see possibly expectations for that carry trade to come back, and Aussie yen could provide some of the more stronger moves, because the Aussie currency has been punished severely over the past couple of years, and Aussie yen definitely could provide us with one of the more stronger rebounds once we do have that trade conflict resolved. And just wanting to go to the dollar Swissy chart, you can see that this pair, and right now we're on a weekly chart. Let me just switch this over to a daily chart. You can see that for the last webinar, when we were discussing the dollar Swissy, one of the patterns that I like to use is the Gartley pattern, and you could see that at times, what we were targeting was just to move right around that 200-day SMA. We didn't quite see the market hit it, but you could see that eventually it did, and you could see that we have been fairly range bound. In this particular case, the pattern was not did not actually come into fruition, but you could see that we have seen dollar Swissy be fairly range bound. But if we do see continued weakness here for dollar Swissy, you can note that we are going to possibly see the 9,700 level provide us with some key support. And if you are looking for a risk-off scenario, if you are looking for opportunities where you really think trade talks are going to fall apart, you think that government shutdown is going to persist, if you're more of a doom and gloom outlook to the markets in the next month or so, you could very well see dollar Swissy provide you with a clear opportunity for a risk-off trade here. And then the last chart I just wanted to quickly touch upon too. We have the Aussie dollar. This one provided, you can see that here the butterfly pattern that you see is a bearish butterfly pattern. We have seen price, after that flash crash, provide us with that key low. Looking at some of the key technical levels, if we do see price close above that 7,200 area, that's where you could start to see further bullish momentum. We definitely would need to see some type of positive comments out of China, out of these talks, and that could provide us with some more room for upside here for the Aussie pair.
Cool. Yeah, cheers for that, man. These are patterns which I guess every technical analyst has their favorites, right? Anyone who's been following my videos for the last few years will know that I'm a big Fibonacci fan. I quite like things like your double tops and bottoms and things like that, and normal support and resistance. I quite like divergences. The Gartley fan, the Gartley and the butterfly, like these are things which I did study as part of the STA, but it's not something I've ever really put into practice. But it's really interesting when you're showing them on these live charts, just watching them play out. It's really quite interesting. So cheers for your input on that. And unless we've got any further questions on here now, I think it's probably about time to wrap things up. So thank you very much all for joining us. I hope you hold on. Is MarketPulse strictly an OANDA product? No, it's not. It's open to anyone. It's an open website. Just log on and check out the analysis and give us your feedback. To be honest, feedback always welcome. There's numerous platforms you can reach out to us on now and find our content. There's obviously marketpulse.com. It's also, this is where you'll find the recording of this probably later in the week. Given the fact that this is for live account holders only, we do want to retain that kind of exclusivity as a result of that, and make it beneficial for you guys joining, aside from obviously just being able to ask questions and interact and see this live. So yeah, you'll be able to find it on MarketPulse at some point. You can also find out all our videos on YouTube as well, and reach out to us on Twitter. My Twitter handle is Craig_Forex. Ed, yours is?
Ed J Moya, EDJMOYA.
Awesome. And finally, check out all of our other content as well. We've got 2 podcasts. There's my own, which is OANDA Market Insights. That's released every Friday. We do that with Jazz FM presenter Johnny Hart. We cover the week's key events. There's also the OANDA Market Beat. That's conducted every week by our colleague over in Toronto, Alfonso Esparza. Again, that's released, I think, around the middle of the week, and very much worth a listen to. And apart from that, I wish you all the very best of luck with your trading. I hope you have a fantastic month. For those of you who fancy it, we're doing another webinar this time next week. This is for all traders. This will be next Tuesday at 12:30, covering FX only. So please do join us then. Thanks, Ed, for joining us this month and offering your unique and interesting insight on, particularly on the US, which is something I'm always interested to hear views from that side of the pond, but also offering your insight on our particularly lovely situation over here.
Great to be on. Thanks for having me, Craig.
And again, all the very best. Sorry, where can I find the podcast? The podcasts are on iTunes. You can find them on Google Play, on the App Store, on any App Store, really, from what I believe. So, yeah, do check them out. And again, give us your feedback. It's always welcome. We're trying to provide content on as many mediums as possible so that we can reach as many people and hopefully provide some of our insight in a useful and hopefully educational manner. So yeah, hope with all the very best luck with your trading. I hope everything goes really well. And again, I hope to see you all very soon. Cheers.